Not long ago, SCHD was one of the most popular ETFs for dividend investors. It consistently outperformed, raised its payout at a good clip, and attracted a lot of new money along the way. But now the narrative has flipped. SCHD has lagged the market, its dividend growth has slowed, and some of its recent portfolio moves, like selling Broadcom before its big run and adding more oil stocks this year, have pushed some investors to the sidelines. But sometimes when sentiment swings this hard in one direction, it can create opportunity. In this video, we'll look at whether SCHD's slowdown is a real problem or more of a temporary setback. Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. Today we'll cover what's gone wrong, review SCHD's current holdings to get a sense of how the fund could perform going forward, and I'll discuss whether this is the time to avoid SCHD or consider it for long-term income portfolios. Let's start with a big picture look at SCHD, which launched in late 2011, and through the first 11 years of its life, it actually outperformed the S&P 500 during a very strong bull market, kind of a surprising outcome for a fund that prioritizes quality companies with great cash flow and good balance sheets. But a lot of that outperformance came in 2022 when the S&P 500 was off nearly 20% and SCHD was only down 3%, highlighting its defensive nature. During most of this period, the fund's dividend growth compounded at a double-digit clip, and it really became the darling of income investor portfolios. Now, the last few years have been a much more trying time for SCHD investors. Since ChatGPT came out toward the end of 2022, the S&P 500 has nearly doubled, while SCHD is only up about 20% and has pretty much flatlined over the last year plus. It's been frustrating if you don't hold growth stocks in your portfolio. That's what's been in favor in the market. I won't get into all the data behind it, but the S&P 500 is at a record concentration. The top 10 stocks represent about 40% of the index. Most of these are tied to the AI theme that investors are really excited about, with a bunch of money being poured into infrastructure and data centers, but most of those revenue streams being far off into the future, creating concerns whether the ROI will be there. But right now, investors are drinking the AI Kool-Aid and shunning SCHD, which, to be fair, during this period also has dealt with struggles from higher interest rates, reducing the appeal of some high dividend stocks, and the effects of inflation and a slowing economy also having more of an impact on these real economy businesses that reside in its portfolio, which we'll take a look at next. I'll be using our website, Simply Safe Dividends, to review SCHD. If you'd like to use our site to track your dividend portfolio, check how safe your income looks, find quality dividend stock ideas, I'll leave a link to our trial in the description below. It's free to try, no credit card required or anything like that. I loaded all 100 of SCHD's holdings into our portfolio tracker here so we could get an under-the-hood look at the fund's dividend safety, diversification, growth, and more. The first thing you'll notice is SCHD's offering a 4% dividend yield based on its underlying holdings. That is probably the highest dividend yield SCHD has had in at least several years. The fund's beta of 0.73 over here means that its returns have been about 20 to 30% less volatile on average than the S&P 500's over the last 5 years. From a fundamental perspective, SCHD's underperformance doesn't really seem to be backed by a big deterioration in the businesses that it owns. This report here looks at the portfolio's dividend income through the lens of our dividend safety scores. If you're unfamiliar with these ratings, they range from 0 to 100. The stocks that maintain a safe and very safe rating are much less likely to reduce their dividends. Of the 900 cuts we've seen in real time since we started doing this a decade ago, investors who stuck with those safe and very safe rated stocks would have avoided at least 97% of the cuts that occurred. So we want to see a portfolio, if you're a conservative investor, with a big dark green bar here. In SCHD's case, 65% of its income is coming from stocks that have safe or very safe ratings. That's a pretty good mix for a passively managed fund. About 27% is coming from borderline safe rated payers. We expect most of these stocks to maintain their dividends, but they have some more risk. And only about 6% of this portfolio's income is coming from stocks with unsafe or very unsafe ratings, which we give at least a 50% chance of cutting their dividends over a full economic cycle. So SCHD's income pie chart doesn't look too bad. Given the fund's underperformance, I don't think it's fair to say that the dividend risk has suddenly increased across the board and is driving that. It's really just that the fund looks so different from the broader market. So If we take a look here at the holdings table, which is really nice because you can pick from dozens of different column options and move them around to get the exact view you want to analyze your holdings, we can see that SCHD's biggest position is Amgen at 4.6% of the portfolio. The top 10 is probably about 40% of the portfolio's value, so they're not that different from the S&P 500's concentration, but the mix is extremely different. I only see one tech stock here, Cisco, in the top 10. You have a lot of healthcare and staples exposure, so defensive areas of the market, and you're not going to see any of the NVIDIA's, Meta, Google, Amazon, Tesla's. That's just not SCHD's strategy at all. If you are unfamiliar with how SCHD picks stocks, it's a passive fund, so it follows a systematic process, and it looks at these 4 fundamental factors. I'll try and put them on the screen here. It looks first at a company's free cash flow to total debt. So companies that generate more free cash flow and have lower amounts of debt get rewarded. It looks at return on equity. So companies that are more profitable and more efficient with their capital are rewarded. It wants higher dividend yields and faster 5-year dividend growth rates. And it weights all 4 of those metrics to create a composite score and picks those top 100 stocks every year when it reconstitutes the portfolio in March. So it's constantly selecting companies that are high quality and offering high dividend yields, meaning they might be out of favor. So you end up with this portfolio of businesses like Coke, Chevron, Pepsi, Lockheed Martin, Verizon, Home Depot, Altria, Texas Instruments, EOG Resources, Valero, Fastenal. Like, these are a lot of really good businesses. A lot of them are probably even in your own portfolio if you're following a quality dividend growth strategy. So I think it's hard to look under the hood at SCHD and say that something is just fundamentally broken about this strategy or stock selection process. It's really just the fund is concentrated in areas that have been either ignored by the market in favor of tech or just facing some of their own, hopefully short-term challenges. So looking at the overall sector mix here, we see tech is just 8% of SCHD versus over 30% for the S&P 500. So there's just no way a fund like this is going to have kept up in the last few years like we've seen, even within tech. I mean, Cisco has some AI benefits that have helped its stock lately, but Texas Instruments really doesn't have any. So SCHD just has minimal to no exposure to the big theme that's been driving the market. A big weight in a defensive area like consumer staples has also really worked against SCHD in recent years. A lot of consumers that have been pinched by inflation are being a lot more selective with what they're choosing to buy, favoring cheaper private label goods. So many of these food stocks like General Mills have been just absolutely hammered. Their stock prices have been falling. Some of their earnings are under pressure as well as they try and keep market share. It's been a very tough environment with low to negative growth. Now, I don't think it'll last forever. It might last for at least a few more quarters, but these factors have really hurt SCHD's short-term performance in the current market environment. Now, that being said, we can see, looking at the dividend yield and P ratio columns in our holdings table here, a lot of these stocks do have yields that are above their 5-year averages, that little line across horizontally. We can see that expectations are just either kind of in line with where these stocks have traded, or they look a little bit low compared to history, which is very different from the broader market. If I pull up this chart here, it's showing the S&P 500's forward P ratio in red over the last 30 years, and the tech sector's P ratio in blue. And we can see that the broader market in red here, it's not had a P ratio this high really since, going back to the dot-com bubble days. And the tech sector has really seen its earnings multiple rise. It's gone from about 20 times earnings just a couple of years ago to north of 30 times now, which is also the highest it's been since the tech bubble started to unwind. So there's a lot of positive sentiment behind tech right now. Earnings have grown, but multiples have expanded even faster. And SCHD's portfolio is generally quite the opposite of that. We see a lot of stocks here that have lower expectations, that are still generating good cash flow. A lot of them are still paying quite safe dividends. They've just seen their growth rate slow a bit, and that has all kind of come down on SCHD's returns those last few years. Ultimately, SCHD isn't a momentum play. It's a rules-based dividend strategy built around quality, cash flow, and yield. When those factors are out of favor or when growth and speculation are being rewarded, SCHD is going to look slow, and that's exactly what we've been seeing. However, history suggests these cycles don't last forever. Eventually, valuations matter again, cash flow matters again, and that's when dividend strategies tend to catch back up. Just this past week, we got a glimpse of what that could look like as the Nasdaq fell over 4% and pulled the tech-heavy S&P 500 down by about 3%. SCHD finished the week flat as some desire for safety and sanity returned. So is it finally time to buy SCHD? Well, if you're looking for an ETF that keeps up with the S&P 500 during an AI-driven bull market, SCHD isn't it. But if you want a disciplined, rules-based dividend strategy that tries to own high-quality businesses trading at reasonable valuations, and you're okay with mid-single-digit payout growth, then today's pessimism might be exactly what makes SCHD worth another look, especially for hands-off investors. And if you want to run this exact kind of analysis on your own portfolio, checking things like dividend safety, valuation, diversification, or research notes, you can do that in seconds inside of Simply Safe Dividends. There's a free trial linked below. Thanks for watching, and I hope to see you in the next video.